Welcome to the Charles River Associates Utility Webinar Series, Finding Investment Headroom in a Rising Rate Environment. CRA is a multinational consulting firm with specialization in corporate strategy and business planning, transaction support, and expert services. I'm Dahlia Ehrenfried in CRA's marketing department, and I'm joined by two members of the firm's energy practice, Jim McMahon and Pat Augustine. The format of our webinar today will be a presentation followed by questions and answers. You may submit questions through the Q&A field on your Zoom browser. A copy of today's slides will be made available on CRA's website following the webinar. I will now turn it over to Jim McMahon, Vice President in CRA's Energy Practice.
Thanks. Good afternoon or good morning, depending on where you're located. My name is Jim McMahon, and I'm out of our Boston office. Today, my colleague and I, Pat Augustine, are going to be talking about the challenges that utilities are facing in finding investment headroom in a rising rate environment. And we'll also discuss some of the approaches that we've seen for better understanding and responding to the issue. So we've divided the presentation into four sections. I'll talk to the first couple and Pat to the back end. We'll first talk through the 5 drivers of increased earnings risk and how those are manifesting themselves in different ways depending on where you're located in the country. Second, we'll talk about capital investment trends that we're observing across the sector and how those investments are being rewarded or penalized depending on their nature. Third, we'll talk about how the external lens is becoming increasingly important in utility strategy and planning, understanding your peers, competitors, new technologies. And we'll provide a short example of peer rate analysis that we did. And then finally, we'll present some thoughts on how you might integrate these ideas into your own business planning process. So with that introduction, let me turn to the first slide. So our view is that earnings risk is generally increasing for many electric utilities as a result of 5 drivers. And we'll talk through these with a little more detail in a moment. The first one, I think most are aware of, low load growth rates leading to higher retail rates, and we'll show what that impact has been and what we forecast it to be. The second is the movement away from what are considered more mandatory CapEx programs to more discretionary programs. The third is customers demanding more, but the fact that they have more options. Fourth, regulators are thinking about the future of the utility model, and we'll talk a bit about what that portends in terms of the wholesale and the retail markets. And then fifth, new utility competitors emerging across the value chain. And what does this mean? It means increased regulatory lag, it means loss of customers, it means competition in what have been traditionally considered bread and butter areas. There's higher risk investment options and new technologies that utilities are pursuing. And ultimately, this can mean reduced investment headroom, which creates earnings risk. So the next slide, we want to talk about each of these drivers in a little bit more detail. So first of all, in terms of load growth, depending on where you are in the country, this is something you've had challenges with, or you've had it's been robust if you're down in Louisiana, perhaps. But generally speaking, energy efficiency is contributing to significantly declining load growth and reductions. And if you look at EIA's historical and projections in terms of customer usage, this is residential customer usage, it shows that lighting use is the primary driver of energy efficiency reduction. And you see miscellaneous growing, and miscellaneous is a lot of plug-in type devices that don't specifically fit into an existing category, but that one's growing and lighting is declining. Now the big question everyone has that's already experiencing this trend of low load growth is, where is the inflection point back the other way, where miscellaneous load overwhelms lighting load? And we'll talk a little bit about that later, especially if you have some questions. But we're also seeing reductions in the HVAC area as well, which are driving efficiencies. Moving to the next slide, I think most utilities and energy ISOs generally knew there was this trend toward greater energy efficiency, but for various reasons, some of them probably more corporately motivated, utilities have had fairly robust forecasts for quite some time that are only now coming down, and this manifests itself to some degree in what we've seen in PJM's load forecast. So this shows the load forecast PJM makes year over year, and you can see they were overshooting significantly, and the latest year, being the 2017 forecast, is nearly flat. So very significant reductions that I think everyone is waking up to. If we move to the next slide, when you have low load growth, I think most utilities appreciate that implies higher retail rates if nothing else has changed. And so this graphic shows history. We'll talk about the future in a second. You look at average retail rates from 2005 to 2015, and we can observe basically three periods. And actually, the actual rate got overlaid here with these graphics, but these are the growth rates for these periods. So there's actually a line behind those graphics that shows the actual retail rates on a nationwide basis, and here's the growth rates. But you see basically three periods. One period, 2005 to 2008, when we had gas prices spiking up towards $12 in MMBTU, and that's what drove the 5.4% increase. You had the period in the B section there where shale production is leading to very low gas prices, and coal and power prices are following as a result. And then the final period, which is the flattening or declining load period, and you still have capital spending and still requirements. So some of this happens through rate cases, some of it happens through riders, but this is representative of the all-in rate. And you can see the drivers down below. The only thing I'll point out there is obviously load growth is flat. Distribution O&M is increasing, though I think lots of utilities are trying to cut that and having some challenges. And these are averages across the country. But utilities are still spending significantly above depreciation levels. So turning to the next slide, when we think about the forecast period, so this is based on CRA's modeling. We have a model that we built actually for purposes of working with a client to understand better their headroom that forecasts out for a set of peer utilities what retail rates will look like. And this is based on those utilities' public forecasts of load, of CapEx, of OpEx, and all of the detailed assumptions that go into building a cost of service model. But basically what you see here is as drivers, low load growth continuing. The energy efficiency gains continue, though they do peter out, and we have that reflected. You have robust CapEx in various forms. We'll talk about that more in a little bit. And then you have increasing O&M, though there is the pressure to reduce it, and so that's reflected as well. But out of the sample of 25 utilities, most of them are growing between 2 to 4% retail rate growth per year. So this isn't a situation where many utilities are holding their rates flat. I think everyone's recognizing the need to grow and the importance of either getting riders or some sort of multi-year framework in place. Moving to the next slide. So focusing on the second driver, as I mentioned earlier on, which is this switch from mandatory to discretionary capital, and then also to higher technology and maybe greater risk capital. So this graphic on the bottom shows CapEx, utility CapEx from 2005 to 2016, so $110 billion roughly. And it shows in the top portion here what type of capital investment was happening during these periods and what the trend was generally. And really what I want to point to is the fact that if you look at environmental and when the majority of the spend in environmental happened, that's a period, a bygone period for the most part. Some utilities have CCR and ELG improvements to make, but I think most of the large environmental upgrades, with the exception of a few utilities, have been made. And where you do have some gas plants still getting built, you have a lot more renewables in the pipeline, and you have grid modernization is the new focus. And we'll talk more about what exactly that contemplates in a few slides from now. But the point here is that we're moving towards more discretionary spending and towards what some would argue is higher risk spend, especially in the form of grid modernization and renewables, perhaps, where some utilities may not have operating experience and want to have that capability. So we'll turn to the next slide. The next driver or risk is around the customers demanding more, but having more options. And the point here is basically customers want more, or demanding more, and that's a good thing. But the bad thing for utilities is that they have more options. So if you think about the set of solution providers across the spectrum now, you have the distributed generation providers, you have the DRE providers, you have the marketers, and you have the renewable developers. And they're looking at innovative ways to begin disintermediating you from your customer. And for instance, in the community choice programs that have emerged in California, it was really a program that started more than 10 years ago, but is really picking up pace now. Direct deals with large customers, DREE is bundling more solutions, and so on. So there's a lot of question marks around how utilities play in that space, and we'll talk a little bit about that in a second. The fourth driver I wanted to talk about briefly was this range of wholesale and retail electricity market changes that are happening and could have significant implications for utilities. So on the wholesale side, it's things like participation by storage in ISOs, the Order 1000 competitive transmission. PURPA maybe wasn't intended to allow as much QF capacity in places like North Carolina as it is. And then state action that's allowing new utilities or allowing new builds to happen from IPPs or making it more challenging for the incumbent utility to self-build. And then the retail market changes, of course, with the retail unbundling and CCA and the direct purchases and the retail choice reemergence in some states. You have the net metering and the tariff changes, and then you have the state transformation initiatives. We could spend 10 slides on each one of these, but the point of it is simply that there's a lot more uncertainty in both wholesale and retail markets, and there's probably a longer list that you could include here. Finally, before we get into some of the capital investment trends, just talking about how utility competition has increased across the value chain. So if we think about the value chain as just simply generation, transmission, distribution, and then I've included behind the meter there, we can think of in gas and renewables and storage, you have new competitors in terms of the private equity plays and Berkshire and NextEra and AGR, and these are experienced developers and operators, and it challenges obviously the utility self-build options. Some utilities are more capable in that regard than others. In transmission, you have competitive transmission, which I would say is maybe hasn't amounted to as many projects as some originally thought, and there's still a lot of self-build options in transmission, but nonetheless, if you live in a service territory where a competitive line is built, you feel the effects of competitive transmission. There's also corridor projects where the competition is happening as well to some degree, and you're not getting a right of first refusal. And low cost of capital players in that space, LS Power won the last couple of competitive solicitations, PJM and MISO. And then finally, distribution behind the meter, obviously a segment where you're seeing a lot of activity and creative and nimble structures and companies willing to be loss leaders, which loss of load has significant implications. So the point is going back to the original slide that talked about the full impact here. There's 5 important drivers that, from our perspective, are driving significant additional earnings risk to utilities. So let me talk a little bit in the next section here about utility capital investment trends and outcomes, and then we'll talk a little bit more about the model that we brought up in the beginning. So utility capital plans today are generally shifting towards these technologies that tend to be higher risk and where utilities have less of a competitive advantage. So if we look specifically at the types of investments, and this is building off of that earlier chart, we see T&D replacement. I think there was a spike in T&D replacement following Sandy, and I think our observation is a lot of that spending is leveling out. If you could take advantage of the fact that storm resiliency was a big concern in the mind of regulators, you did. And while there is always going to be rebuild options, that's an area that tends to be flat at the moment. If you look at transmission and renewables, there's a increased RPS and utility interest in rate-basing renewables for good reason. If you can, replace or put in new capital, if you could swap out O&M for capital, that's driving a lot of these transmission and renewable combinations. Companies like Excel are obviously very favorably positioned. AEP is getting more into that space. Generation replacement, we saw the spike in generation replacement as a result of MATS and other environmental rules, but there's been somewhat of a downward trend since then, since a number of coal retirements. But there still is a decent pipeline. You look at environmental, again, that major spend related to CCR and ELG is still out there for many coal-based utilities, but generally speaking, it's not a large issue for more than a handful. But then you turn to the right side of this graphic and you look at grid modernization. And we break grid modernization into three categories: phase 1, 2, and 3. I put only a couple of utilities in phase 3, like Edison International. A number of utilities are really just embarking on phase 1 or really fleshing that out. And then I think a good number are moving into phase 2. The phase 1 utilities are, some of them got the ERA funding years ago and were able to build pieces of their system. AMI and related communications, that gives you the basic DA structure. It doesn't allow you to do nearly what all of smart grid contemplates, but it does provide some application. Phase 2 is a much more extensive DA rollout, the back-end systems implementation around the MDMS, the meter data management, the outage management systems. And then phase 3 is really getting into full DER integration through distribution system upgrades and technology. So these are, I think we're seeing very significant shift of capital towards these areas. And we also see a shift of capital away from the utilities for some. So looking at, maybe they can invest in their LDC or they can invest in the pipeline, where they think they have greater advantage. And I think that's a recognition of some of the greater risks in the electricity business. So moving to the next slide, I think the question arises then, so some companies have been able to invest aggressively in terms of new technology and earn their premium returns. So you look at the Edison example, and back in 2012 they had their 5 million smart meters rolled out. They started with a large renewable storage mandates. They had a DRP plan for distribution resources and a mandate to do that, and a real visioning of this networked grid. And then by 2016, they have these plans they're rolling out, storage, they have renewables and transmission, they're looking at DER services, they're looking at, they have approvals for EV charging. Now, this is very much specific to Edison and PG&E and San Diego in their service territory. But it does definitely bring up the question, how they're able to grow at a 3% CAGR on retail rates and enjoy the premium returns. They're top TSR performer in the last 3, 5, and 7 years, just after following the Edison mission challenges of the IPP. And then you look at companies like on the next slide, Avista, which have had more challenges, and this is a UBS report, but I think we saw it with Avista and some other companies as well, up in New England, in fact. Just rejecting Avista's rate case, this whole concept of fatigue at the commission, and UBS talking about this sort of broader risk to utilities that they don't want to spend on on distribution, and it really asks, whether this regulatory compact is going to work to drive sustainable earnings growth in an environment where you are seeing, 2+% retail rate growth. So turning to the next section, I'm going to hand off to Pat Augustine, who's going to talk about some new considerations in capital investment planning and talk about a peer utility analysis that we did to show some retail rate growth estimates for a few utilities out there, and how that concept can be integrated into the overall planning cycle. Pat?
Thanks, Jim. So the second half of the presentation here is going to be focused on just that, and try to walk through some considerations on how to apply these observations and trends to maybe a broader perspective on utility planning, and then, as Jim mentioned, walk through a utility analysis that focuses on a couple of examples that will walk through the trends and the observations that we have, and walk through a forecast that we've developed based on some of the developments that we're seeing in these example utilities. So the next slide here focuses on at least an introduction of a capital prioritization type methodology and tool that is common and certainly exists across the utility landscape. But what we've observed is that utilities will tend to be very inwardly focused on this type of exercise, where the tool, such as the example that we're showing on this slide, very much ranks internal projects based on a whole set of risk scores or metrics, but doesn't really include an external lens. So the point here is that capital prioritization and capital planning is often done on a selection of internal projects without a specific or direct view on how peer utilities or others might be undertaking a similar strategy or a different strategy, and how that might ultimately drive rate growth and headroom in front of regulators. So what we're seeing and advising our clients to look at is really taking a look at how the greater market risks that exist should be broadened to look at a perspective that goes external, and rather than focusing solely on those inward-looking metrics and ratings, to look at external factors. So on this slide, what we're pointing out is a couple of different processes and evaluation frameworks that utilities can take to undertake peer utility analysis, maybe a competitor analysis that gets very specific in terms of what other challenges are out there in line with those that Jim outlined, and a technology risk analysis that takes a look at what a utilities plan might be compared to, again, what risk they may be undertaking by going into new businesses or advancing down the renewable or grid modernization paths. So what we're focused on here is the peer utility analysis, a question to really look at what actions peer utilities are taking, why, and how this is ultimately impacting retail rates. And we think this is quite important because we believe utilities will be increasingly pressured and required to explain how their rates compare with others, particularly in the same jurisdiction, whether it's with the state regulator or perhaps within a region or an ISO that they operate, to really have to face the questions of why they may be different than other peers. And what we're outlining here on this slide is a comparison that we did for two example utilities. The specific utility we were looking at is represented with that bar all the way to the right, and this was their all-in rate of about 11.5 cents per kilowatt hour. And comparing them to a peer in a neighboring state with somewhat of a similar profile, but we were asked to look at what those differences might be between those two rates and whether we could explain them in order to be responsive to internal strategic questions, but also external pressure from the regulator. And there are many drivers that can explain this difference, of course, based on the status of the system, the composition of customers, whether there's a large industrial base or not, what type of investment choices have been made, what the location and the demand patterns and the weather in the service territory might be. But what we've pointed out here in the middle is what type of gold plating might have been done. And this is very much a focus for regulators, or a term that regulators might use to assess whether there have been appropriate and prudent expenditures of costs, and what type of isolation of that type of metric can be done versus all of these other external factors. So with this as an important background, what we're finding is that evaluating these key differences in different jurisdictions is very important. And in order to do that, you have to have a handle on what peer utilities are doing. Another way to look at this peer type analysis is to evaluate the trade-offs between rate growth and earnings growth. And we'll circle back to this concept as we walk through the little case study that we'll go through. But what we're illustrating on this slide here is a study that we did on about a dozen or so utilities, where we looked at the next 10 years and spelled out their plans in generation, transmission, distribution, load growth, and how this might be impacting their rates, but also at a high level, at least, their earnings. And take a look at where utilities are positioned against each other. And effectively what this is doing is summarizing the amount of headroom that the utility may have to invest, and where that headroom is coming from. And as an example, what we're pointing out on this slide is that a certain utility that was focused more on PPA renewals and less aggressive on distribution spend may have a modest rate growth, but that comes along with modest earnings growth on the bottom. Whereas other utilities that may have had projections for very similar modest rate growth were able to drive earnings growth by switching from operating costs to CapEx. And there may be ways to do that. But our point here, I think, is without understanding the landscape of other peers or others that you may be compared to, utilities may not have an understanding of where their headroom stands in relation to others. So with that as the background, we'll step through an example of a peer utility analysis that tries to put some of those high-level talking points into practice, and at least points out the types of information that you can look at and the types of analysis that can be done. So we conducted a very high-level comparative study that's intended to proxy a peer study, but rather than focus on one particular utility or set of utilities that we've looked at in a specific region, we've selected 3 distinct utilities to make it easy to compare some major trends and observations, rather than a set of specific peers. So the 3 utilities here are not necessarily peers. They're in different geographies, have different sizes, but we found these in the course of our work to be quite interesting, in the sense that they have different strategies, different customer bases, different generation fleets, and can kind of tease out some of the key questions and observations that we've been hinting at in the introduction to all this. So the 3 utilities that we looked at were Avista, Consumers, and Minnesota Power. So very briefly, for those that are not familiar with these entities, Avista is a Washington state-based company operating primarily in the Northwest, electric and gas utilities in Washington, Idaho, and Oregon, 375,000 electric customers. And as Jim hinted at before, they've been in the news lately due to denial from their regulators in Washington on rate increases and that rate fatigue comment that was made before. Consumers is a much larger company, Michigan-based utility providing electric and gas service throughout a good portion of the state, excluding most of Detroit and the Detroit suburbs. But 1.8 million customers, and they've got an interesting and diverse system that's working through issues with coal and nuclear and a transformation of their fleet going forward. And finally, Minnesota Power, a smaller utility that's based in Duluth, Minnesota, with only about 150,000 electric customers, and they've been noteworthy as well with a fleet transformation that they're undergoing from coal dominance to a more diverse mix. So each of these utilities has a distinctive strategy going forward, and it reflects their unique positioning. And as we hinted at before, when you do a peer analysis like this, we found it interesting to start with a review of the strategic emphasis for each of the entities and where that might be driving them going forward. So Avista has been very focused and continues to be focused on upgrading infrastructure and grid modernization and maintaining their customer value. And we'll get to that in a couple slides where we talk about their customer mix. Consumers Energy, on the other hand, has a clean and lean strategy. They are moving forward with a very clear plan to shift from OPEX to CAPEX, all on a no carbon or low carbon type environment as they shift away from coal primarily. And Minnesota Power has an energy forward plan that's very focused on reliability and affordability, but has a goal of moving their fleet from what was historically dominated over 80–90% by coal generation to one that mixes in quite a bit of gas and renewables. So if we take a look at the starting points of each of these entities from a portfolio standpoint, you can see that they're quite different. And in order to understand where each of these entities might be going forward in terms of rate growth and headroom and earnings growth and earnings is at risk, it's certainly important to take a look at the generation portfolio and where it stands now and where it might go in the future. So as was mentioned, each of these utilities that we looked at in this case study have quite a different portfolio of generating resources, both that are owned and under contract. Consumers historically has been among the more diverse utilities in the fleet here, or in the subset that we looked at least. Historically was quite coal dominant, but went through a major coal retirement program that ended last year to take their share of coal generation down below 30% or so, and has a significant nuclear contract that has made a good portion of their generation historically. They've been shifting now to renewables and gas, and you see on the bottom graphic below that pie chart an expectation to get out of the nuclear contract and make quite significant builds on the gas front, maybe upwards of 2,000 megawatts of new gas builds in the state of Michigan over the next 10 years. In addition to that, there's a new RPS law that was passed over the winter in Michigan, and they have a plan to heavily invest in renewables, primarily wind, to comply with that. Minnesota Power in the middle has quite a different existing generation mix. As I mentioned, historically was and continues to be very coal dominant. They've had a growing share of renewables, primarily wind, and they have an objective to move from 75% coal to maybe more in the order of 30 to 40% coal. And in order to do that, they have plans for some retirements and then some additions to bring gas into their system for the first time, and to bring in some new renewables, including some large-scale hydro through PPAs for Manitoba. And finally, Avista has historically been a hydro-dominant utility, so very unique in that regard, at least when compared to these other Midwestern utilities, with over 50% of their generation coming from hydro and smaller shares of gas, coal, and renewables. Notably, they don't have a plan to invest much in the generation sector since they already meet their RPS requirements, but they expect to perhaps require additional gas builds to meet reliability needs going through the next 10 years. In addition to very different generating fleets, each of these three utilities has quite a different customer profile. And as we mentioned before, understanding this profile is quite important to understanding the demands of the customers within a specific utility, but also understanding how rates are structured and how they might start off in terms of the mix of different customer classes. So what's notable on this slide, of course, is right in the middle there, Minnesota Power having a predominantly industrial consumer base. And this has a couple of important implications for the utility. One is that their customers are very price sensitive. These industrial customers require energy as a major input, of course, to their processes and bottom lines, and are going to be very price sensitive when it comes to rate growth. And secondly, it does impact the load factor of the system, very high load factor loads in this system, which contributes to a low dollar per megawatt hour or cents per kilowatt hour type rate. So understanding that is important to taking a look at how their growth might go go forward in the future. Consumers in Avista tend to be a little bit more mixed. Avista has over 40% residential, which is fairly high and above the national average. And as we hinted at before, they're very focused on meeting their customer needs when it comes to sustainability objectives, but also reliability in terms of their upgrades, not only to the generation system, but more importantly for Avista, the local distribution system. So with all of that as background, what we have done in this case study is produced a fairly detailed buildup of each of those utilities portfolios and capital investment plans and spending plans in order to get at a retail rate forecast, which is ultimately the main objective of this peer rate study. And we've deployed what we call our peer electric rate forecasting model, or PERFORM, which calculates a bottom-up estimate of cost of service and retail rates down to the class level, at least at a high level. This model is based on a whole series of key inputs, publicly sourced data on CapEx forecasts that are published by the utilities through investor presentations and 10Ks, financial assumptions that come out of their rate cases, as well as our views or client views on commodity prices and technology costs of new builds and new additions and retirements. And of course, we have the ability to run through scenarios and certain sensitivities to test all of those inputs on the left-hand side of this graphic. The model does do a full dispatch analysis, so we're dispatching portfolios against load, against markets where they exist in ISOs, and we're doing a full integration of PPAs and market sales and purchases to try to get at a fairly rigorous look at the generation fleet and how that might vary over time. And that rolls into a cost of service calculation for each of the generation, transmission, distribution components that handles tax depreciation and other tax implications and rate buildups to ultimately get at a retail rate. We found that this tool can help forecast those retail rates, not only for the specific utility in question, but also their peers, and allows us to flex not only those input scenarios, but other regulatory risk scenarios to take a look at comparative metrics across the board. So turning back to the three utilities that we looked at before we get into the forecast that came out of our analysis here, we have a starting retail rate to benchmark each of them. And as was hinted at before, these utilities tend to operate in different service territories, different resource bases, different customer bases, and thus have had quite different retail rate histories. Minnesota Power, as was mentioned, has a very large industrial customer base, which keeps load factor high and per kilowatt hour rates quite low. And this has also been a factor, or another factor driving this has been low coal prices, access to relatively cheap hydro and wind in that region as well. Avista has historically been closer to the national average, but generally a little bit lower as a result of low cost and well-depreciated hydro in their system, although recent distribution spending has pushed growth rates up quite a bit. And consumers, on the other hand, has been historically quite a bit above average. This is a result of a more expensive generating fleet, including higher cost coal resources, more expensive power purchase agreements, and also quite a bit of distribution spend in recent years, keeping that rate above 12 cents on average. So going forward, what do we see? We see quite a mixed picture across each of these three utilities. As was hinted at before, Avista is expected to continue to be on the high end in terms of growth rates. They may certainly have certain mitigants available that we're not capturing based on a public forecast like this. But what we're seeing is very flat, possibly declining load growth for Avista, and a new gas build that appears to be in the system, and very high spending on the distribution system, as you see in the bottom center graphic there. And as a result of all those factors, we're seeing a growth rate of 4.5% compounded over a 10-year period, which is quite significant and which raises the question of whether there'll be continued regulatory pushback and regulatory risk and a lack of additional investment headroom going over the 5 to 10 year period that we're looking at here. Minnesota Power and consumers, according to our analysis here, tend to fall within the average range of rate growth that we've seen across the dozens of utilities that we've looked at recently. Consumers is an interesting story where they have significant investment in the distribution system and quite significant investment in the generation system as well. If you recall, we had about 2,000 megawatts of gas expected to be built or brought into the system through asset acquisitions, as well as several hundred megawatts of new renewables. Yet with all that investment, we're forecasting their generation rate to only increase by about 1.5% per year. And the reason for that is, as was discussed before, the ability for them to really focus on a strategy of exchanging OPEX for CAPEX, getting out of PPAs for the Palisades nuclear unit that was in the news recently, and another high-cost gas PPA that they're under right now, and reinvesting that money into capital projects that have lower O&M, such as gas and gas CCs in a low gas price environment, and renewables that have upfront CAPEX but very little operating costs. So what we found here is that consumers is an interesting case study where significant earnings can be potentially realized while keeping a relatively low rate on rate growth. And that's an attractive story if you're looking at them from an investment point of view, but also something perhaps to keep in mind if you're viewing them as a peer and taking a look at where their investments might be able to, or what they might be able to achieve versus your own. And finally, Minnesota Power is also roughly in line with that growth rate, but for very different reasons. They have minimal investment in the distribution system that's expected, very modest investment in the generation system, primarily due to the fact that they're pushing forward with hydropower purchase agreements, and their investment in the transmission system is allowed to drive some earnings while overall keeping those rates in line with prevailing market prices and at least in line with general inflation trends that would be expected. So overall, just to conclude this part of the presentation, I think what we're finding by this type of analysis is it allows you to do a fairly good dive into the utilities generation mix, their capital expenditure plans, their customer base and customer composition, and ultimately drive all of that together into a rate forecast that can tease out some of the key trade-offs between capital investment, rate increases, earnings growth, and potentially the headroom that exists for each of these entities. And at the end of the day, hopefully, at least from a peer analysis, this can give utilities an opportunity to look at how their plans may compare with others, especially when it comes to planning for regulatory pushback or taking a look at all of the other risks that Jim highlighted at the outset. And I think I'll turn it back to Jim to close here on our final thoughts on integrating this in your planning cycles.
Thanks, Pat. Yeah, so just a couple notes on how you might think about integrating this sort of external lens look in your business planning process. So what we've outlined here is really just a sample business planning process. It tends to be year-long, culminates in this 5-year plan and budget for the following year, strategy planning exercise as well that goes into that. And typically, business planning starts in the early part of the year. You do your state of the system, and then you get into your advanced rate case and financial planning. And so just to think about on the next slide, how you might integrate some of these concepts, you know, to really do an effective job at, turn to the next slide, Pat. Oh, there we go. If you think about integrating these concepts and the timing of when they're going to be important in your analysis and your decision making, we talked at the outset here about really a high-level scenario development exercise, which you may already do as part of your strategy, and it may just be an expansion of that. But that's really what's going to drive your assumptions about what some of your peers are doing as well and how their assets are going to perform how their generation is going to dispatch, how their load's going to grow, and perhaps how some of their strategies. So there's a scenario development exercise that really starts at the front of this, if you haven't already done it. And then the peer utility analysis, it tends to fall in this time frame of mid-February to through April, May, to give you enough time to react from your business planning process. As we all know, you have to prepare your budgets for early fall. You have to, well ahead of that, have a well-constructed business plan, typically to look at in early June and maybe through the summer. So it's really important to conclude that exercise before it gets too late in the planning year. Also, you get new information about what your peers have done when the FERC Form 1 data is released. So that's usually a useful benchmark, if nothing else, is a history lesson on what happened in the last year, but it's also a good basis for creating some new projections. And then in your competitor and technology analysis, we didn't do a long discussion on that, but we could talk for a while on those sections as well, and that's something you want to be thinking about too. So just on this final slide here, some questions that you want to be asking as part of these three exercises. In the peer analysis, some important questions up front are, who are our utility peers? And it's interesting, right? Because there's compensation peers, but there's also a set of peers that maybe are more relevant for strategy and planning purposes, and they may be peers that you haven't thought about before. So I think there's a thought exercise as a group to really understand who should be our peer, and they may not even be regional peers. And then think about differences with respect to geography and customers and regulatory and capabilities and all the things that Pat talked about a moment ago that differentiate them, at least from a rates perspective, from you. And then what are they doing in terms of CapEx, OpEx, regulatory strategy, and what does it imply for retail rate growth? And really the ultimate question is, what type of value are they providing to their customers versus what you're providing, and does your customer value that differently than their customer? On the competitor analysis side, there's lots of questions, and I won't go into a lot of detail because we didn't really cover this in depth, but I think these are important questions to be asking around the different offers that your competitors are providing, how much growth there is around those offers, how competition changes with regulatory and technology changes, and then how that factors into risk weighting. And then finally, on the technology side, I think that really is embedded in this. It runs across technology, runs across competitor and peer, but it's what is the nature of technology investment you're making? How is it changing over time? Getting into risk weighting those different technologies in some of your decision making, because it's not the same investments you were making years before. So just to close out this section and really the webinar, and we can move over to Q&A here, we're observing increasing risks to the electric utility as a result of those 5 factors we talked about. And nonetheless, I think we see utilities pursuing very aggressive capital strategies in some areas where they have less evolved capabilities and where newer technologies are involved. And our view is that you need to really bring this external lens to the table and supplement the existing planning process to look at peers and competitors and this technology evolution to ensure that you're making the choices that are going to drive growth, not just in the near term, but also longer term. I think a lot of utilities would admit that there's a cliff that they see in their capital spending in 5 years, 10 years, whenever the case may be. It's typically beyond their forecast period from a financial forecast perspective, but I'm not sure they all know exactly what they're going to be investing in the future. So, how do investments you make today provide options in the future? And unfortunately, there is no one-size-fits-all approach. Some utilities can invest heavily in grid modernization like Edison and expect premium returns, and others will struggle in moving from mandatory to discretionary type investments and really need to think more about O&M reductions or regulatory constructs or even allocating capital away from electric toward maybe other businesses they own or even towards M&A. So with that in closing, let me turn it back to Dahlia for any Q&A that we have. Thanks.
Thank you, Jim and Pat. I'm now going to open up the floor to questions. You can submit your questions by clicking on the Q&A tab on your browser. I think we might have a few in the queue, so why don't I start with those. Did you look at any market uncertainties in the case study and how they impact the relative rates?
Pat, you want to take that?
Yeah, this is Pat. I'll take that. We didn't do a specific look at a whole series of uncertainties in this particular case study that we outlined here, but it's certainly something that we have done in certain applications. And for some of these companies, we have actually subjected them to some market uncertainties that I think the question is getting at. So some of the things that we would typically look at, of course, are fuel price uncertainties, gas price risk, how flat are gas prices likely to be, or will they be, or is there potential for them to grow over time? Is there carbon pressure that could come back? Also, the capital costs of new builds, especially around the renewable front, are key sensitivities and scenarios that we've looked at. So if you look at consumers, for instance, which we were talking about having the ability to shift from OPEX to CAPEX and keep rate growth at a relatively modest level, we did look at that utility in the past under different assumptions on gas prices and renewable costs. So for instance, a faster increase in gas prices would hurt that story that we're referencing here, because they're shifting away from a nuclear PPA towards quite a lot of new gas combined cycle in the system. So if gas prices were to spike or rise faster, their overall rates would likely be going up at a faster clip, and perhaps more so relative to others that may be keeping more nuclear or even coal in their system. Similarly, renewable capital cost trends can also impact things. So a utility like Consumers or Minnesota Power, where they have fairly substantial investment in new wind or solar, can certainly, the overall rate impact can be impacted if you assume that the cost declines continue for solar, or perhaps they peter out, and that combined with tax subsidies and incentives at the federal level expiring could actually result in some upticks in rates that might not be expected under other forecasts. So I think there are certainly many market uncertainties that are important, and as you might imagine, they can impact different utilities in different ways, again, based on their composition in their portfolio and where that might be changing over the next several years.
And we have another question. How many companies were in your rate studies?
I could take that. I think we had about 25, but just to be clear, we don't produce or publish a rate study, on any sort of regular basis. But we built a tool and have done several different analyses depending on the group of peers. So this one, what we referenced here, we had about 25 different utilities that were somewhat regionally focused.
Okay. How much do you think of storage as a game changer?
Oh, well, that's an interesting question. Yeah, Pat, you want to answer that?
Yeah, sure. I think it certainly has potential to be a significant part of the mix going forward, and a significant part of utility portfolio planning going forward. So I think there's probably a few elements here. One is the magnitude of that. I think in the near term, even the next 5 to 7 years, probably not going to change a lot of the big picture items that we've been covering today in terms of the scale of storage investment versus the distribution and other generation activities that are going on. But I think beyond that, we're seeing it in certain parts of the country where it's being mandated or encouraged or looked at by FERC. There certainly could be a real movement to push into that direction, and that could go and be spent by utilities, or it could be disruptive on the other side. So as Jim was hinting at in his earlier section on distributed generation, behind the meter technology, I think that's one area where we see it as a potential threat. So if the utility is not spending there, could we see storage with solar type programs behind the meter cutting into that load growth that is really one of the most important parts of this entire rate equation. So I think what I would say is that on the distributed side or the behind the meter side, it has a potential to be disruptive and contribute to the declining rate load growth outlook, I should say, for utilities. And as a result of that, it could impact those rate growth. But on the flip side, there's certainly investment opportunities as the system shifts away from a lot of baseload resources and maybe goes more to a renewable and gas and potentially storage mix.
Okay, I think we have time for a few more questions. There's one here. Is there a region that you find particularly challenged with headroom?
Yeah, I mean, I could start first, Pat, and you can maybe supplement. I think, you have to consider a few different things. One is obviously the starting retail rate. It's interesting with it, like a Vista. Was it a Vista, Pat? Yeah, that had a low starting rate, and was actually, the rate increases or the percentage rate increases probably look a lot larger than they are on a actual dollar basis relative to some other utilities, because they're starting from a very low cost due to hydro and other factors. So I think a company like that has headroom issues, but it's really probably because of the sticker shock of the large rate increases and the percentage rate increases, and the need to go in for rate cases year after year and not really having a regulatory framework. It's very state specific. So states like Michigan have had very favorable treatment and ability to get investments made in their systems on a regular basis, and good regulatory support. So to me, it's very state specific, unfortunately, and I'm not sure I can define it from a regional perspective. I'd have to probably think more about whether there's any clear regional themes. I don't know, Pat, if you have any other thoughts on that.
No, I think that's fair. I think we're seeing, at least on the generation side, a lot of coal and nuclear capacity right now under pressure, and the Midwest does come to mind as an area where you have a lot of that, and requiring potentially large investments to replace that in an environment where load is just not growing or is negative in a lot of those regions. But as Jim was mentioning, it's very specific in terms of where the starting position might be, how the regulator is treating their utilities within their jurisdiction, and potentially what other elements of the portfolio may be in place right now based on historical contracts that were signed, historical investment in T&D or other elements. So I think it's quite state or utility specific, although there may be some large trends about areas where load growth is the weakest and where there's generation pressure especially.
Okay, I think we have time for one last question. Do you think utilities are overvalued given some of these risks?
I mean, I could start, Pat. I think certainly some utilities are overvalued, and probably some are undervalued. I think the street's looking for a story, and some utilities have a pretty compelling story for the next 5 years. Some have a compelling story for longer. It really depends on what opportunities they have within their service territories, and it also depends on all these things we've talked about in terms of competition and peers, and how familiar they are with the technologies that they're investing in. I do think, though, that we're approaching a period where you're going to see a lot of more questions being asked to executive teams about their strategies and what that long-term growth plan looks like, especially as it moves into grid modernization. If we think back to that slide that had the 3 phases of grid modernization, if you're Southern California Edison and you've been able to tell a compelling story all through that process to get you to full DER integration, and you become that sort of network company that provides all the pipes and communications and potentially takes a interest in the downstream assets, that's great. But if you're somewhere much earlier along in that process, I think you have a lot of work to do to tell that story. And you have to have a set of ratepayers that understand the value and are willing to pay for it. So I think we'll see some shakeout, and I think the industry, the sector, is becoming more risky, and I think that's what's driving a lot of the shifts you're seeing, and the changes in capital investment and movements out, and some PE firms thinking they can get in, and so I think that's what I would say about that. It looks like we're over time here, Dahlia, so maybe it's a good time to end.
Yes, thank you. Thank you, everyone, for joining today's utility webinar series. We look forward to you attending our next webinar on utility gas hedging risk, which will be announced in the coming weeks. Again, a copy of today's presentation will be made available on the CRA website at www.crai.com/energy. Thank you, and have a good rest of your day.